What if I told you that doing nothing during stock market crashes can actually make you richer? In this video, I will show you how stock investing actually works in real life. There are no complicated terms here, only simple ideas anyone can understand. This story begins in 1985, when I started investing at 18 years old. In the early years, my money kept growing and everything felt under control. Then everything changed on one single day known as Black Monday. In 1987, the United States stock market fell more than 22% in just one day. Fear spread everywhere, and millions of investors panicked and sold their stocks. Friends warned me to sell immediately before losing everything. Instead, I chose to stay invested and do absolutely nothing. Over time, the market slowly recovered and reached new highs again. Years later, another major collapse arrived during the technology stock crash. During the dot-com crash starting in 2000, the National Association of Securities Dealers automated quotations. Composite index lost nearly 80% of its value. Once again, fear returned, and people begged me to sell before it was too late. This repeating pattern reveals the most important lesson about how investing truly works. The lesson is that stock market crashes are painful, but they are temporary. After every crash in history, markets have eventually recovered and moved higher. This pattern appeared again after the technology crash ended in the early 2000s. By 2003, stock markets began stabilizing and slowly growing again. Many investors who sold during fear missed the recovery that followed. Then, in 2008, a much larger crisis hit the global financial system. Major financial institutions failed, and lending between banks almost stopped. Stock markets around the world fell sharply as confidence disappeared. In 2009, stock markets reached their bottom and fear peaked. Instead of selling, I stayed invested and continued adding money regularly. By 2013, the United States stock market recovered past its previous highs. Patient investors were rewarded as markets grew for many years after that. Then in 2020, a global pandemic caused economies to shut down almost overnight. Global economic output fell by about 3%, the worst decline since the Great Depression. Yet once again, staying invested set the stage for the next powerful recovery. After the market bottom in 2020, stock prices began rising much faster than most people expected. Within months, markets recovered a large part of their losses. From the bottom, stock markets rose more than 25% in a relatively short time. New all-time highs followed, even while many people were still afraid. This is why trying to predict crashes and recoveries usually fails. The market often recovers when fear is highest and confidence is lowest. Over decades, this pattern repeated again and again without exception. Staying invested through crashes mattered more than choosing perfect moments. Over my investing lifetime, this approach produced an average return of about 11.23% per year. That return was not smooth and not easy, but it was consistent over time. To understand what this really means, let us look at a simple example. Imagine investing $250 every month without trying to time the market. You are not chasing hot stocks or reacting to scary news headlines. You simply invest regularly and allow time to do the heavy lifting. This is where the real power of long-term investing starts to appear. When you invest consistently, time and compound growth begin working together. At first, progress feels slow because most of the money is your own contributions.
But over time, compounding interest takes effect.
Over many years, growth starts generating more growth on top of itself. This effect becomes stronger the longer you stay invested. Now let us put real numbers behind this idea to make it clear. Investing $250 per month equals $3,000 per year. Over 30 years, you would personally invest about $90,000. With long-term market returns, that amount could grow to over $1,000. Most of that final value comes from growth, not from your own money. This is why starting early matters more than investing huge amounts later. Many people delay investing because they believe they need more money first. In reality, time is the most valuable resource in investing. The market rewards patience far more than intelligence or luck. This approach does not require predicting crashes or chasing trends. All it requires is consistency and the willingness to stay invested. Before investing a single dollar, there is one critical step most people ignore. You need an emergency fund before you ever invest in the stock market. An emergency fund covers 3 to 5 months of basic living expenses. This money protects you from selling investments during market crashes. Without an emergency fund, fear forces people to sell at the worst time. Another important rule is never investing money you need in the short term. The stock market is built for long-term growth, not quick emergencies. Once your emergency fund is ready, investing becomes much less stressful. Now that the foundation is set, the next step is opening an investment account. Decades ago, investors had to call stockbrokers to place trades. Today, investing can be done online in just a few minutes. Choosing the right type of account matters more than choosing individual stocks. In the United States, tax-advantaged accounts can dramatically increase long-term results. These accounts help reduce unnecessary taxes on investment growth. Understanding this step alone can save you tens of thousands of dollars over time. In the United States, one of the most powerful investment accounts is the Roth Individual Retirement Account. With this account, you invest money that has already been taxed. The biggest benefit is that your investments can grow tax-free over time.
Look at how your $10,000 can become.
When you withdraw money during retirement, you do not pay taxes on the gains.
By starting early at age 20,
There is a yearly contribution limit, so starting early really
Your
matters.
investment grows significantly more than if you wait until 40. The earlier you start,
The earlier you start, the more years your money has to grow tax-free. Opening this type of account is simple and can be done fully online. Most modern investment apps guide you step by step through the process. Once the account is open, the next question is what you should actually invest in. Many beginners believe they need to pick the perfect stock to succeed. In reality, picking individual stocks is extremely difficult, even for professionals. This is why most long-term investors focus on diversification instead. Diversification means spreading your money across many companies at once. By doing this, one company failing does not destroy your entire investment.
For beginners, the simplest and most reliable strategy is
This idea leads directly to the simplest and most reliable strategy for beginners.
your investments grow.
The strategy is called
That strategy is called index fund investing, and it removes most guesswork. Instead of betting on one company, you invest in many companies at the same time. One of the most popular examples is the Standard & Poor's 500 index. This index represents about 500 of the largest publicly traded companies in the United States. Companies are added or removed based on their size and performance over time.
By investing in the index,
When you invest in this index, you automatically own small pieces of all these companies.
diversifying your portfolio instantly.
If one company performs poorly, others can balance the results. This greatly reduces risk compared to owning just a few individual stocks. Historically, this index has delivered strong, long-term returns despite many crashes. Investors who stayed invested through crashes were rewarded over time. This strategy does not require watching the market every day. It works best when combined with automatic monthly investing. Automatic investing removes emotion and builds discipline. Over time, this simple approach beats most complicated strategies. This is why index investing is often recommended for beginners. Once your account is set up, investing can be done in just a few simple steps. You choose an index fund, set a monthly amount, and turn on automatic investing. From that point on, your money works quietly in the background. You do not need to react to scary news or daily market movements. Over years and decades, this habit can grow into something life-changing. The biggest risk is not market crashes, but never starting at all. Even small amounts invested consistently can make a huge difference. Investing is not about being perfect, but about staying consistent.
The earlier you begin,
The more time works in your favor. Now you understand how investing truly works and why simple usually wins.